even though my base case is that it's not really a huge cut to deficit spending. I think that probably either stays the same or even goes up. But the period of time where the market can most easily run away with itself and get scared about that is going to be in the first half of next year. So if anyone traded during 2018 or the first 2 years of Trump's presidency, really the or I guess all 4 years, the unpredictability of Trump, especially when he has a red sweep, and his kind of musings can be taken potentially very seriously. Uh, it introduces a lot of volatility, and I think that the market has kind of forgotten that a little bit. Like, I do think that he'll be good for growth, but there, my view right now essentially is the risks of things being taken negatively, and before they're actually implemented, just based off things he says or things he says he's going to do. It's pretty pronounced in the next 2 quarters.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Chief Strategist of Citrini Research. So Citrini Research, they sort of cover equity with a top-down approach. So thanks so much for coming on the podcast.
Thanks a lot.
No problem. Looking forward to speaking. You have a, I've listened to a few of your interviews, and it sort of got me interested in your strategy and how you look at the markets and what's really, happening in the world. Is sort of quite unique, I think, from what I've what you see normally. So I'd be interested to hear more about, I guess, your approach, your strategy, and maybe how you got to this point.
Well, I think that first off, I appreciate the fact that you've kind of read or listened to some of the stuff that we've done. That's always nice to hear. But the thing that we try to do essentially is we write research that will never leave you asking, okay, so what's the trade? We basically just focus on crafting a kind of differentiated view by looking at what's actually happening in the world and trying to create what we call thematic frameworks that look at these narratives and markets. It's there's a quote that I don't want to misattribute, but essentially it goes something like, price today, price is a number today multiplied by a story about tomorrow. And we try to focus on those stories. And I don't think that anyone has ever gotten a piece of research and looked at it and went, God, I wish this was a lot more complicated. So we do a lot of work into the nuances, but when we present it, we try to make it as kind of cohesive in terms of the actual storytelling of it, because that really, at the end of the day, is what makes people go into a market and make a decision. So right now, what we're working on, I kind of locked myself into a article that we published at the end of the year. In 2022, I did 22 trades for 2022. So now I've gotten a lot of people that will say, well, what are you going to do in 2050? So, but I guess that's a problem for future me. And right now we're working on 25 trades for 2025. And the premise of that is kind of, it always struck me as weird, the trend in sell side research of the year ahead outlook. Because if you think about it, if at any point in the year you have a really high conviction angle on what you think is going to happen over the next 12 months, you're not going to wait until December to publish that. So I think what I try to do with the 25 trades is drop the pretense, right? I predicting what markets are going to be like a year from now is kind of a fool's errand. So instead of really trying to just, here's everything that I know is going to happen, which ends up basically just extrapolating what the consensus is right now, I try to let myself be a little bit more creative and drop the focus that we have on really being right about everything and accurately predicting throughout the year. It can be kind of stifling to creativity. and that's an important part of creating a differentiated approach. So that's what we're working on right now. And I just finished probably 2 hours ago with the 25th trade. So
Perfect. Well, I'm sure we'll get into all those trades, and everyone's yeah. But I've been thinking about this quite a lot recently in terms of what drives markets. And you mentioned it there, it's sort of the story of the future. And I talked to David Rosenberg, and he was trying to sort of explain to himself, and I think really he sort of has been quite bearish last year. Obviously, he's gotten it wrong. Trying to explain to himself why did he get it wrong, and it seems to be that as you said there, narratives, stories drive markets. So do you think that's sort of what we've seen? And do you think this has sort of changed? Has this changed for you in the past few years, or is it just becoming more extreme, or is it these massive secular trends that are driving it? Well, I don't know if you have any thoughts on this.
well, don't get me wrong. Stories do drive markets, but there's stories about real things, right? They're stories about things that are actually happening, and that's not just on the upside. I think a lot of people tend to mix up the idea of a narrative driven market with a bull market, and that's not the case. The in 2022 there were plenty of stories that drove markets lower, whether it was increased geopolitical volatility, or the end of the you know kind of the just multipolarity in geopolitics, or if it was the end of lowflation and inflation coming back strongly. And really, it's my view, at least, that the reason that we avoided recession rests almost primarily because of fiscal spending, and that was something that we covered in 2023. Uh, and that creates a pretty interesting dynamic when, in the end of 2022 and 23, we basically completely messed up the script, where we were supposed to go into a recession, and a lot of smart people were looking at the data, and if you looked historically, it looked exactly like the setup that you would have to go into a recession. But instead, we got what people have termed immaculate disinflation. And the best possible environment for equities, especially, is to be coming out of a high inflation environment with lower inflation and persistent growth. So that was really, in our view at least, primarily driven by fiscal spending and deficit spending. Every single dollar of deficit spending is a dollar of corporate profits. That's just that's not like a speculation. That's just an accounting truth. So it's interesting, as we go into this new year. There's a lot of bullishness about growth, and at the same time, there's a lot of discussion about a new administration that's going to be focused on cutting the deficit. So that is mildly worrying, I would say.
Yeah, no, that's very true there. What do you can you maybe take us over 2024, because it's something that it seems you got quite well, and maybe from there we can sort of go into the future.
Yeah. So there were a few things that I got right in 24. There were a few things that I got wrong, just like everyone else. But I would say the main reason that 2024 was good was preparation. There's a quote from Colm O'Shea, ex Soros guy, that says fundamentals aren't about forecasting the weather; they're about noticing that it's raining. And or so basically, you're not predicting, you're observing. And I think that was a big part, taking that general approach of just observing what's happening and creating a framework for it, and instead of forecasting exactly what's going to happen, forecasting the potential scenarios that could unfold based on what's happening right now. So a good example of this is, unlike some other research firms, we published our outlook for the election in March of 2024, and we focused on the idea. You have to remember that in the end of 2023, the odds that Trump was going to be the candidate for the Republican Party were below 100. So we saw that as a lot of room for upside. We didn't really see a market that had priced in the odds that Trump would not just be the candidate but win. So when we wrote that article, I think depending on whether it was polling or prediction markets or whatever, but kind of the aggregate percentage chance of Trump being the next president were around like 33 or something. So we wrote out essentially, here's the trade for Trump's odds rising, and we went through a bunch of different themes, or I guess sub themes of a Trump victory or Trump's odds rising, and that spanned everything from speculating on the privatization of Fannie Mae and Freddie Mac to being long European defense versus short U.S. defense on Ukraine normalization and the enforcement of the 2% GDP target that for NATO. We covered some of the onshoring trends, M&A trends, deregulation, everything. And by being prepared for that kind of thing, when as it got closer to being realized and as it was realized, it made for a very easy. Once you already have a plan in place, it's super easy to just go and execute it. So that was definitely one of the things that we did right. I think probably the biggest component of this year was just getting comfortable with being uncomfortable. There were a lot of points in time this year where, you know, in August, for example, one day you wake up and everyone's a expert in the yen carry trade, and it takes a if you haven't been monitoring that, it's easy to look at a market that's just melting down over the weekend and say, oh, this is going to be bad, because the market wouldn't be acting like this if it wasn't going to be bad. But if you're kind of taking an approach that has that's always kind of aware of large trends in markets, and that's not limited to equities, right? Most of the time when people talk about thematic investing, it's thematic equity. I think that's not really a good framework, because these themes and narratives and trends exist in a cross asset way, right? So the yen carry trade and the yield curve control normalization in Japan, that's a huge trend and a huge theme. So we had covered that in 2023, and by being prepared for it, and by having noticed that there was some level of correlation between U.S. momentum and the performance of the yen versus the dollar, we were able to pretty easily not just take advantage of that, but dismiss it as unimportant when be the bidder of last resort to that. So, I think being able to kind of stay bullish this year on a top down level was a huge contributor. Just that it seems simple in hindsight, but there were plenty of points where it was pretty complicated. So that's how I view what's happened in 2024.
Okay, so I guess you have sort of all these frameworks in your head, or you write them down in terms of these are the potential trends, or these are trends that happened previously, and then from there it's sort of, okay, if this were to happen, then you sort of have a basket of assets that are either going to perform or underperform. Is that sort of how you look at it?
Yeah, exactly. And that's like I said, that doing this exercise, this massive list of trades for the upcoming year, it's an important part of that, right? Because there. First off, these aren't all like these trades. They're not all going to work. Most of them won't. The scenarios that would be necessary for them to happen won't arise, or something will change. I mean, 12 months is an eternity. But even if 24 of them don't work, but one of them does, when the conditions necessary for that trade to work come about, we will have an edge in preparation, right? Because uh, like what happened with the election, the I was actually pretty surprised by the way that markets reacted to the election, because I figured uh, before the election that a lot of this had been priced in. Because we came into the election with Trump was essentially a lot of the stuff that you would expect to go up on Trump. I expected it to go up, and not to the degree that it did. It seems like the market was very offsides on that one, especially in like boutique M&A, and the kind of negative impact on U.S. defense, and across the spectrum, pretty much everything that could be impacted by that had a massive repricing in the wake of it. So being prepared for that with a comprehensive list of expectations for what would happen in kind of like a cross asset manner was a great edge. And now, instead of sitting down and saying, here's here's my year end price target on S&P, like, why would I do that? All right, it's like something will happen the first 2 weeks in January that'll completely change that. Instead, I say, here's 25 things that might happen, and here's how you prepare for that. So, you know, uh, and I think that encapsulates pretty well my approach to, if anyone ever asks me kind of what's your edge, it's really just the mental flexibility to create the research necessary to be prepared. So that's kind of what I'm working on right now, and I think I have some interesting ones if you want to talk about them.
Yeah, no, definitely. So yeah, let's get into it. What are your what are the 25 trades for 2025?
How about this? I always get a little bit unsettled with like the interview format. So, what do you? How about what are you paying attention to the closest for like top of mind three things that you think will move markets? Let me flip the script a little bit, and then we can kind of make it a little more conversational. What would you say?
Can you come back to me? I need to think of a I need to think of a good answer. Yeah, I know. God, you put me on the spot here. It's meant to be the other way around. No, I guess, yeah, the classic, but these are things that I think I have a different approach in terms of more company-led, in terms of my own personal investing, so more company-led, and then you sort of make sure there's a narrative behind it, but it's a evaluation of the companies, as well as a few other factors. But then, there's obviously AI, technology. I think China is a big trend, and, we've obviously had a pretty poor guidance from the sort of uh, government recently, with people expecting a little bit more. So disappointed again. And then biotech is another one that is pretty interesting. But those are, yeah. Let me think a bit further to maybe I can add it back.
Well, I think no podcast about markets would be complete without talk of artificial intelligence, right? And so uh, it it was pretty interesting, I think, over the past couple weeks, seeing some of the names, like just for example, Broadcom earnings were a big deal. That if you look at that, basically the only reason that it was in line was because of VMware, and that wasn't a good acquisition, but and the attrition will be high, but they made up for it so completely in AI. And the same thing with companies like Sienna or Credo or Coherent, and so we covered this a little bit, talking about interconnects and optical, and that being a bottleneck to the idea that you can't just be a hyperscaler and buy a bunch of GPUs and kind of sit them on the table and say, hey, do AI, right? You have to. There's other stuff that needs to happen in terms of the communication, and be so. when I see kind of what's being talked about between Amazon with their Trainium 2 and the Apple, there was a headline about Apple potentially working with Broadcom on an AI chip. Uh, it seems to me, I'm going to get a little weird with it real quick. So, uh, if you look throughout history, it's pretty rare that you have a company that has a company or an entity or whatever that has a monopoly on a revolutionary technology, also has high margins, and is able to maintain that monopoly for an extended period of time. Right? That it's I guess it's like a vacuum, right? Like nature abhors a vacuum. Well, markets abhor a monopoly in paradigm shifting technology. So there's probably like the longest that ever went on was you'd have to go back to like uh, the 16th century and with like Portugal and the arquebus, and they managed to essentially maintain that monopoly for longer than a decade, but eventually they got disrupted, right, by the musket. And that's kind of when you look at a situation like this, essentially Nvidia's moat is obviously they make the best GPUs, and they also have CUDA, right, which is another huge moat. But eventually, especially in inference, 100%. So AI training and inference, training the model versus actually having the model infer things and run. Those are two separate things. And with inference, it's a lot easier because it requires a lot less of that parallel computing aspect that GPUs are good at. But if you were to take the last big thing in GPUs was Bitcoin mining, and for a while, if you wanted to be a Bitcoin miner, you basically bought a melt crate, and then you put a cheap motherboard in there, and some PCIe risers and a power supply that were very cheap, and then you spent your money on like 6 to 8 graphics processing units, graphics cards, and that was your Bitcoin miner, and that was pretty expensive, especially when, as graphics card prices went up because of crypto. But eventually they made what's called application specific integrated circuits. These are basically systems that are primarily focused on just doing Bitcoin mining, and eventually that same thing will happen to AI compute. And whether or not it happens right now, it's really a focus of it happening with inference, but it could happen with training too. And I'm not saying that it probably won't be better than what Nvidia has, but if it can manage to be on the same level or maybe even a little bit worse, it kind of commoditizes the whole thing. And so looking at the risks for 2025, breakthrough in ASICs or a shift to ASICs, that could, because of how significantly overweighted Nvidia is, and how much money they make with that kind of monopolistic approach with these cards. There's If we did have a shift towards ASICs, the pie would shrink. Uh, Not only because the margins would be lower, but at the same time because it would kind of get commoditized. So if you look at kind of the risks from everyone kind of thinks that as AI progresses, increasing the technological aspect is a good thing, right? It should be good for markets if we make a technological breakthrough. But in this instance, it could be bad because if Nvidia is making a lot less money, and that gets kind of spread out across the companies that would benefit from supplying for ASICs and kind of like what's called custom silicon, that could be a risk for the index. If you kind of am I making sense here, or have I gotten too in the weeds?
Yeah, no, that makes. I actually thought you were going to go into ASML when you were talking about monopolies and these and the technologies. So But yeah, but no, it does make sense. So you're sort of saying they're such a large player. There's so hundreds of billions of capex basically going into Nvidia and other companies that if that were to slow down, it sort of will really affect second layer, third layer, fourth layer companies that sort of support them as well.
Yeah, and then eventually we do have to get into the proliferation, or what other buzzword could I use? Like the democratization of AI, right? Up until this point, kind of the gains have pretty much primarily accrued to the hyperscalers. And what you saw with Salesforce in their earnings essentially was they reported earnings, the stock was down, and that huge reversal was pretty much driven by one thing, and that one thing was mentions of agentic AI. So it seems like that has the makings of a new theme for the next year, where especially because you've had a lot of software companies have been viewed through the lens of this kind of AI cannibalization and downside because of AI. So, let's say that maybe 75% of those are right to be priced as AI losers. If 25% of them aren't, that's a huge kind of re-rating, going from not just a loser to a company that's not affected, but like a loser to a winner. That's kind of a big deal. And so uh, AI agents essentially have, I would say, five key characteristics. The first would be autonomy. They kind of operate independently within defined boundaries. They choose actions based on the goals expressed for the agent. They have goal-oriented behavior, so they kind of pursue objectives that have been set by humans using reasoning and planning, and that's why there's been such a big focus with like ChatGPT with O1, kind of focusing on reasoning. They're adaptable, so they can learn from their environment to better adjust and achieve outcomes, and they make their own decisions, and they're kind of they have like an interactive capability in terms of how they react. So essentially, what that means is being able to set up. An example would be if you have like a scheduling agent, and being able to just walk down the street and never really look at your phone, but maybe just by talking to this AI assistant and say, hey, when's that podcast with Anthony scheduled? Oh, right. Yeah. My call is running a little bit late. So send him an email, say I'll be 30 minutes late. Oh, and also I remember that I wanted to have this follow up meeting with who was that I was talking to last week about so and so. And basically, the idea is like agents can act on their own, and they kind of know what to do. And whether that's an enterprise or consume, B2B or B2C. So that seems like a big deal for the next phase of AI, is actually finding the not just the kind of classic companies that are going to benefit from it, but and like the hyperscalers, but finding these kind of companies, because they could be across industries, right? That they don't have to be technology companies. They can be companies that are simply improving their efficiency because of AI. So that seems like a big one, but I do think that there is a distinct risk to the overall index and performance from challengers to Nvidia's throne now that are actually starting to materialize.
So do you think that would be better off for the challengers or sort of worse off for Nasdaq? Because I guess the trade here is that sort of short Nvidia that you're thinking, or
Well, I mean, it's more. I mean, so the companies that would benefit from that kind of successful challenge uh, would obviously do well, but Nvidia is a very big part of the index now, and so that and you'd have to basically weight it with like the fact that the hyperscalers have spent a lot of money on NVIDIA GPUs. So if it kind of becomes easier to buy a bunch of ASICs for cheaper to get like similar compute and capabilities as the hyperscalers that have spent billions of dollars. And if that adjusts the hyperscalers' capex plans, and and Nvidia, which has become this largest company in the world, and it gets negatively affected, the gains that would accrue to kind of companies like Marvell and Broadcom, they probably would not make up for it at the index level.
Okay, makes sense. It's more sort of impact on the index that you're thinking
Yeah.
about.
Yeah, and while we're on the topic of risks, like I said, uh, there really is a distinct aspect of this economy that's been driven by fiscal spending, and my base case is not that Donald Trump is going to come in and actually cut the deficit. I think that he's against. He's not necessarily against government spending as much as he's against government spending on things that he doesn't like. So I think that there's a distinct possibility that you have some cuts that are simply just spent elsewhere on different things. So that can be something that we've been talking about a lot is the beneficiaries of deregulation, and potentially offsetting that with a short on companies that have benefited massively from the Inflation Reduction Act, and might not benefit from more Trump priorities in fiscal spending. But at a macro level, if the deficit does get cut, that will be bad for the economy. I think it's as simple as that. And I think that risk is more pronounced than the kind of inflationary risk that is presented by tariffs. I think that Trump will focus primarily on trying to negotiate a deal with China rather than just these kind of like punitive. I don't think that we're going to see like an exact replica of the first kind of trade war that we got into with China. I think that the tariffs and the hardball, it's all towards a larger goal of trying to negotiate a deal, and that kind of colors my view that I'm more concerned about a potential market being worried about the deflationary risks of Trump than inflationary. And I know that's probably very out of consensus, but uh, you really can't separate how the economy is doing from deficit spending. So that is probably that there is certainly a risk there, and I think that even though my base case is that it's not really a huge cut to deficit spending. I think that probably either stays the same or even goes up. But the period of time where the market can most easily run away with itself and get scared about that is going to be in the first half of next year. So if anyone traded during 2018 or the first 2 years of Trump's presidency, really the or I guess all 4 years, the unpredictability of Trump, especially when he has a red sweep, and his kind of musings can be taken potentially very seriously. Uh, it introduces a lot of volatility, and I think that the market has kind of forgotten that a little bit. Like, I do think that he'll be good for growth, but there, my view right now essentially is the risks of things being taken negatively, and before they're actually implemented, just based off things he says or things he says he's going to do. It's pretty pronounced in the next 2 quarters.
Okay, yeah, that makes a lot of sense. So you think instead of sort of like, I guess, small cap, IWM, those type of things are going to benefit at the expense, you said, of maybe the hyperscalers and the Nvidias, as there's sort of a differing, I guess, narrative, or do you think maybe it could all be a bit quite choppy for the first 6 months as things steadily?
Yeah, I think that it depends on the time. Like over the course of Trump's presidency, I do think that small caps will outperform, and a part of that is just base effects. But I do think that throughout this whole kind of bull market, the period of time that I see the most, because for a while we've had a lot of like walls of worry that have been built throughout this, since we troughed in October of 2022, but they've been relatively easy to overcome because of how strong some of the drivers were, right? So uh, if you think in like the third quarter of 23, we started going down, and then uh, some of the air was taken out of SMH, and then when earnings came around, and everyone was reminded of this huge effort in the data center build out, and how broad based and far reaching that was. uh, we just got over it, and that was easy to do because valuations were more forgiving. Now we're getting to a point where they aren't, and uh, so while I wouldn't say, like I said, I'm not going to like set a year end price target for next year, but I would say that the risks to the downside are pretty pronounced for the next couple quarters, and that we'll probably need to see how the market reacts to like Trump tweets again.
Yeah, exactly. It seems like they've sort of they've been able to sort of look past anything he says, basically. So people are sort of just ignoring it now because they're like, "Oh, it's a negotiating tactic. He's not serious about these things."
Yeah, exactly, and that's kind of part of the risk, right? It's like because all you need is like, we go into this situation from the inauguration. We say, yeah, whatever, he says stuff, and then whatever. All you need is like for like this like cascade to start, is like he says something that's like really significant, and the market's like, oh man, even if there's even like a 5% chance of that happening, we're screwed. And then some people say, well, I don't know if I want to underwrite that risk. That 5% seems a bit, the left tail's a little bit too fat on this one. And then and you get kind of like a and with the market that the way that it is, and optimism so broad based and everything, it's easy to get a lot of volatility in response to those kinds of things. So uh, yeah, that's basically where I'm coming from. But I think that there are areas that should do well regardless. I really like LNG right now. I think that there are a few companies that really will benefit very significantly. I don't know how these get into like smaller companies, and I don't necessarily uh, with like individual tickers it gets a little bit dicey. But you know the other thing that I would say, kind of looking to the future at least. Um, this is so since we just covered the risks, let's talk a little bit about maybe the upside that's being discounted. Um, were you trading in 2021?
Yeah, a bit, not very successfully, but a little bit.
And, yeah, well, so I guess it depends. I guess if you were a short seller or if you were like long only. Although the root word of nostalgia is it means pain. So I guess regardless, you might have looked at the market over the past few weeks and felt a sense of nostalgia for 2021, and that got me looking into some of the things that outperformed in 2021, and that took me to some of the kind of darlings of that era. A lot of it was, colored by how COVID was going, and obviously it was extremely speculative. This was, the golden era of Kathy Wood, and
The
every
Zooms, the Teledynes, all
yeah,
those.
yeah, Tiger Cubs putting up amazing
Yeah.
numbers, and so, but what I noticed essentially, I started looking at some of these stocks like AppLovin and Carvana and C. These are the same stock, right? They're all kind of the same stock. Basically, what happened is they were able in when it was happening, right? And when this 2020, the correction of like, that started in 2021 and went into 2022 was happening, a lot of their strategies were viewed as like reckless and misguided and gross capital misallocation. You had companies that were doing these huge, like Carvana did a huge infrastructure build out, and they did a lot of stock based compensation to attract talent because the tech labor market was pretty tight. They got these crazy valuations when money was cheap, and then the air was sucked out of that, and some of them went down 80-90%. And then in the case of companies like AppLovin or Carvana, they rebounded, right? And not only rebounded, they like took out the highs that they made in 2021. Some of these companies are actually, what they're doing in EBITDA right now is higher than what the estimates were at the peak of 2021. Now, don't get me wrong, right? I'm not saying like every 2021 fallen angel is along, because some of these names are absolute garbage, right? But at the same time, what we've termed this is some of these companies have what you could call a temporal moat, right? Where they were essentially able to utilize the environment of the speculative bubble, the money being extremely cheap, um, to kind of build their business in a way that now that money's expensive, you never could. You simply couldn't recreate it. It would be too expensive. The environment isn't there anymore. And they've some of them have really embraced cost discipline and trimmed fat and reined in customer acquisition costs and prepared for a moment where their end markets pick up. And when that happens, like what we saw with Carvana and AppLovin, the incremental margin leverage kind of dwarfs whatever the market could imagine or is imagining. So that kind of, it's an interesting, you say, well, if the market keeps going up like it has, um, and you had this kind of winnowing process where, I mean, you think about Carvana, with their competitive environment completely changed. Vroom went out of business. The four major competitors was reduced to two, and this kind of competitive intensity reduced. So my idea was, well, I look at these stocks, and some of them, you talk to people, and their reaction is just like they have a serious anchoring bias, right? Because of how badly that these stocks affected them, or their P&L, or uh, maybe led to career risk being realized in 2022. They're just averse to it, but they'll own maybe one or two, and they'll just view that individually as a turnaround. So my framework for this kind of idea is essentially, what if that's not just isolated to these two companies? What if it's actually, what if we should look deeper and basically try to see if like Carvana and App are not isolated cases, but maybe kind of like the archetypal beneficiaries of this kind of trend. So, and the other thing, is in a market where like even the most cyclical of industries is trading at 25 times next 12 months earnings, or more. If the market continues to rip, I don't think one can afford to be super cynical about names that are trading at the lows just because they are fallen angels. So, I started looking into kind of a basket of these names, that where you basically just go through all the Tiger Cub, uh, like 13 Fs and from 2021, and say like, 80% of them you're just like, oh god, that's terrible. Some of them, a significant portion of them already went bankrupt, but the ones that are left, that they it's worth at least running the numbers on them and seeing, did they actually use this to their advantage.
Okay, that makes sense. And then, yeah, so sort of what are some other is there maybe another trade that you can, uh, tell us about that you're looking for next year?
I mean, again, uh, this process of discerning trades, it's all about, here's what the environment would look like where this trade would really do well, and kind of setting yourself up for like, really having no like creative hurdles, and not just like immediately dismissing anything, or just looking at the environment and kind of creating a list that's like it's like a thematic watch list essentially. And yeah, yeah, because I already have a portfolio, right? And I have the stuff that's in my portfolio, and I like that stuff. And it's a good thing to keep up to date on those. But kind of if there's any time of year to kind of explore, not necessarily what is happening or what's likely to happen, but just what could happen. That it's now, and so. There are themes obviously that we cover that I'm still bullish on, that I'm still going to remain allocated to. So this process is a little bit more of like what could go differently, right? Like a big we covered a couple themes this year that were basically they did rhyme, right? Where it was like you had this big whether it was like a COVID inventory glut or overbuild, that kind of drove this like cyclical correction during the normalization phase, and all that was kind of worked through, and then you had these themes that were still experiencing secular tailwinds that were kind of ignored by the market, both because they had done so poorly since the COVID bubble, and also because of the fact that it was kind of like a Dutch disease, right? Where why would you go looking for names that are going down when you have like the best theme ever in AI, and Nvidia goes up every single day? So essentially, we started looking at some of these themes that had, I guess we call like anti momentum, right? And instead of basically trying to hedge our book by going short stuff, we said, well, some of these areas that we've covered, like GLP-1 drugs with Lilly and Novo Nordisk, and or artificial intelligence, or these kind of fiscal beneficiaries, and like the power grid, and grid modernization, electrification. So when you're successful in thematic investing, and investing in these narratives, uh, the it's not really downside, but it is what happens is your themes and your picks become momentum factor, and that exposes you to this kind of hot money, whether it's like the quants or pod shops playing factors, and the investor base becomes much more focused on things that aren't necessarily related to your thesis, and that can increase your risk. Like we saw, just recently, you had a big unwind in pure momentum factor, or August 5th, right? The first to go when the market experiences weakness is kind of like the stuff that's been going up all the time, right? Because people want to protect their profits. So rather than express kind of like bearish views to offset these long exposures, we started looking into some areas that could kind of benefit from a momentum unwind. So it's kind of like an implicit hedge, where because if we had just put on, say, Nasdaq puts, or Nasdaq futures short as a hedge for AI, that creates the worst possible environment where you can like you can lose on both sides of your trade. Whereas like if you can have a positive expected value hedge, that's the best thing in the world. So we looked at like the three that I would say kind of rhyme with that overall would be, we covered earlier summer, I think in the end of June or beginning of July, we covered the telecom cycle, and talking about these names that had these kinds of tails from AI. Sienna was one of them. We compared Sienna's revision cycle to Nvidia's when it had dropped, and but people were quite bearish on them because of they didn't really want to own anything that touched telco, right? But you had an environment where maybe it wasn't gonna get a bunch better, but either the rate of change on the downside was going to slow down, or maybe it was going to start going sideways. So and then we also covered like healthcare and med tech that had been hit pretty hard, especially in small and mid cap. And then finally in September we covered payments, which was that was a quintessential one because during COVID, um, every investor in the world eventually had the realization that like we're all stuck inside, and the only thing that we have to do is spend money and pay each other with all these stimmy dollars, and that created it kind of followed the hype cycle exactly, which was basically I don't know if you're familiar, but the hype cycle is like you have a technology trigger or like a narrative trigger, and then you get this massive outperformance that leads you to this what's called the peak of inflated expectations, right? Where everything is priced in essentially. Then when those expectations aren't met, you have an unwind that brings you to what's called the trough of disillusionment. That's basically when the everything is bad, right? And no way that these companies could recover. And then what happens is, while the market doesn't recognize, you have this kind of the tailwinds that drove the peak are still around, and they still kind of contribute to these companies' earnings, and the companies are still taking advantage of them, even though their stocks are destroyed. And so you get to this kind of plateau of productivity. And that was the kind of chart that we led with payments. Was it was a broad index of payment stocks, and the two lines were essentially the blended 12 months forward EBITDA, and then the other one was the price of the index. And you see this huge rise up and a big drawdown, and they follow each other one to one, and then you have EBITDA, right? The forward EBITDA starts going up for like 6 months, but the stocks just go sideways. So we looked at that, and then you know. It's too early to say if we were right about like the fundamental picture, but it certainly has happened that people were more willing to look into companies that weren't necessarily like a classic AI, hyperscaler, et cetera. Mid cap kind of broadened out, and then also you had payments were probably payments and financials in general huge beneficiaries of Trump winning, because you get this kind of deregulatory push, and at the same time, you have hopes for a growing economy, which is obviously good for payments. It's just there's something about like when a stock is going down, it's like when a stock's going down, you go in, you look, you reevaluate your thesis, you get some conviction, you say, oh, the market's wrong. When a stock is going sideways, like in a broad way, just like sometimes it's up and like, and when it goes up pretty significantly, pretty quickly, right? And you're like, yeah, I knew it, right? I'm fucking killing it. I got this. And then it completely reverses and loses more, and like, and when it does that for 6 months, and you look at it and you're like, oh my god, I'm like flat to down on this position, but at the same time, the Nasdaq is up, 25%. It's super super difficult to stay invested, and that's what happened to me on Marvell. I had this whole idea of Marvell as kind of the core beneficiary of the hyperscalers trying to make their own AI chips, and maybe like an ASIC breakthrough, and then the general trends in connectivity. I was early to that, too early, because it was the most frustrating price action ever. It was my biggest position coming into the year. Although I own a lot of positions, but it was my biggest. and then I sold it at the exact lows. And so I was right for the right reason, and I lost money. So
I'm glad it's not just me then. It's a very common trend.
yeah, the listen, the investor, no matter what you do, the investor psychology aspect is that's our shared experience, and that's why I don't I assume that some of my readers would say that I maybe focus too much on it, but I do focus pretty significantly on trying to analyze not just the psychology and sentiment and positioning of the market, but of myself, and really forming an understanding of where my blind spots are, where I'm likely to kind of make a mistake, or and then applying that, because the thing is, we're all much more similar than we are different, especially when you look at it in an aggregate sense. So a lot of times when I remember I'll offset that Marvell thing with something that I did right just to make myself feel better. But if you think about 2022, there was a lot of stuff where you went in and clicking the buy button was like the scariest thing you could possibly do, and you really had to take like an objective look at stuff where you would go into it. And this is where like being macro informed kind of helped out a lot, because you could go in and you would just run an analysis of here is the worst possible case if we repeat the global financial crisis. Here's like how this sector generally would be affected, and like here's the downside to that. And you would look at some of these stocks, and it's like, okay, so looks like global financial crisis represents 15% downside. It's like, well, that seems low, and I should probably buy that. And what one of the areas that I was able to do that with was like office commercial real estate, which was very much more a kind of reading the psychology of it than fundamentally looking at it, because fundamentally looking at it and especially from the top down, where with like the work from home shift and everything, it was very easy to say, oh, this is a fundamentally and structurally impaired business. But at the same time, it was I like buying Vornado and SL Green at like the same prices that they were trading in years and years and years ago. So that was a good one where if you get familiar with the way that you think when things are really bad or when things are really good, and the errors that can lead to, you can get a little bit more comfortable with doing those uncomfortable things.
Yeah, it's great. So, James, thanks so much for your time today. We sort of over an hour, so we had a really good conversation, touching on so many different things.
I feel like it was only me
Last,
talking, but yeah, sorry.
no, that's all right. That's what people want to hear. They don't want to hear me.
Well,
But yeah, I was going to ask. Normally, I ask all my guests, what is one message you want people to take away from the conversation?
give me a second on that one. That's we're switching gears real quick. I guess the one message that I would want people to take away from this conversation, I would say maybe during the holiday, we spend all year trying our best to be accurate forecasters, and be right about things that are going to happen, and kind of really, that gets rewarded, right? The effort and research that goes into trying to be right on balance tends to be rewarded more often than it's not. But at the same time, that can be a pretty stifling environment where you can become prone to either overanalyzing things, or underanalyzing certain risks, or even just being blind to certain opportunities because you're too worried about being wrong. So I would say that the message that I would say the message that people could take from my approach to the end of the year is it's better to give yourself a period of time where you try to just not worry at all about being wrong, and just kind of blue sky things. And you know, most of what you come up with won't be good, but the stuff that is will be super differentiated. And even though there are some cynics that would say this isn't true, when we operate in the market, we do tend to be going up against very smart people, right? The market is controlled by people that control the most money in general, and the people that control the most money tend to be pretty intelligent. So a lot of times, the edge that you get is from being differentiated and being mentally flexible. So I would say give yourself a little bit of time and kind of drop the pretense and just spend a day thinking about like what if, and preparing yourself for that. And if it never comes to pass, you're out a day, and if it does, you'll be very well positioned.
Perfect, great message. So thanks again for coming on. If anyone wanted to find out more about your work and what you do, is it? I'm guessing it's Citrini Research.
Yeah, SitriniResearch.com.
Perfect. I'll put it in the description. But thanks again for your time.
Thanks a lot, man. Have a good one.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.